All right, so just a reminder, especially if you're new in here, I'm a bit sensitive when I'm recording because, as you saw, I'm a little bit freeform and funny and fun when we're all just kind of hanging out. But I try to watch myself when I'm here because the last thing I need is to get canceled when something's taken out of context. And so I encourage you to think the same way, too, that we are being recorded. So just be sensitive to that, please. So here is the way that we work together when we're recording things is, again, so within Teams, inside of the general channel, I've started a meeting. You don't have to join me in the meeting at all. It's just a measure for me to record. Once we're done, it will appear for you on this general posts area. And after its processing is done, it should be able to be visible for you. What's also nice too is it will create a folder called Files, Recordings, and then underneath it, when I name it, it will give you the name. So it shows me that today is 10/31/2023, and I named it for us, FRICTO example. So if we do a bunch of these during the course of the quad, you'll be able to go back and retrieve and find them easily. Because what I want to do is turn our attention a little bit now. We started with more of a macro perspective of here are the things that finance managers are worrying about. I'm worrying about foreign exchange rates. I'm worried about a 90% distribution. This was a problem for us. It was a requirement. It was a control issue. And when we're running that formula about funds that are available for distribution and we're finding we're falling short, well, then what do? We got to go out and borrow money just to give it out. It was a significant issue that we had to play with. So one of the things that I always like to start with is more of like a triage of the internal health of a financial organization from the guts inside first. So imagine you're going into the doctor and, they make you get on the scale first. Like, why don't you piss me off? Oops, see, why don't you make me unhappy to begin with and tell me how fat I am to start this appointment? Before then, you tell me how bad my blood pressure and everything else is. But I've learned over the course of my years, it's data that I can plot. And so I can look at it from age 22 to 52, and I know what it's going to regress. And sometimes I'm better and sometimes I'm lesser, but I have to be honest with some of those categories. So the categorization we're going to use today is an analysis that's an acronym that's called FRICT. So I'm going to point to two things to begin with as our starting points. So first, out of the syllabus then, here we are today, and I'm prepping you up for the assignment that's called A3 Company FRICT video. So I know for a couple of you, I made a comment, I think, about the reason I start with the video recording is so that you get comfortable using the interface with screen share so that you can give a good presentation that's not just a talking head, but it's a talking head with graphs, with data, with financial statements that allows for audio, visual, multi-sensory inputs to tell your story, because that's what you're going to do for me this next time. There are two links in here that try them and make sure that they work. Because I know with one of your class members, I was struggling to get access, but I snipped a couple of brief pages from some traditional finance textbooks. I don't think it's illegal because the copyright permissions allow me to take up to 10%, and I didn't take but maybe even 1/10 of 1%. But there are two different PDFs in here that give you a nice review of FRICT. So I'm going to pull up both of them and keep them onto the side for us, and I encourage you to do the same. So here's the first one, FRICT number 1, and I'm going to go ahead and download so I can launch it and open it in PDF rather than inside of a web browser, which makes no sense to me. And then the second one should start with chapter 1 on the very top, and it's called Basic Frameworks. So let's download both of those, and let's have those as our supplemental learning material right here. Please don't open it in the browser. Excellent. Please don't open it in the browser. Excellent. For FRICT number 1, I want you to look at page 420. What I forgot. It's no, where is it? Part 5, diagnosing from intro. Okay, here we go. Everything talked about so far. Is that me? Oh God, thank God. All right, sorry. It's like, God, my voice has changed. 446. So right here is where I want you to start. Part 5, what is best? 446 on that one. I think it's page 13 on this one is where it starts. 7, 8, 9, 10. Is it 15?
Yeah.
Oh, page 15 up top. I was looking here. 13 down there, 11 here. This one, analyzing long-term capital structure. So these are the ones that I want you to cross-reference. Then from there back into our Teams, since we're going to be doing this video, let's pop on over to Teams and make sure we understand the assignment so you know what we're going to use these for. I'm going to go to General, and I'm going to go to my assignments. I got to click on the one called FRICT. I make it look like I'm a student. And here's what you're going to do for me. I give you a little template that's basically just a PDF version of an extraction from those 2 PDF articles. So if you want to, feel free to download that. We can have that one open too. You're going to pick a publicly traded company. I'm going to do Nordstrom today. And what I'm going to do with Nordstrom is we're going to use 2 separate research resources. I'm going to use my favorite equity markets point of view research, which is Morningstar, because it's a Chicago firm and because they do great quantitative analytics. And I'm going to augment that for my accountants with the 10K, because we're going to look and hear what they say about their disclosures as it relates to certain categories. So we're going to have 2 primary research inputs that we're going to use. So you're going to pick one, you're going to use a template, you're going to fill that matrix out, and I am very intentional with naming structures. Those of you who are with me the last several weeks, you know, yeah, she's shaking her head, having flashbacks like, oh God, like, BSE 2310-Rand- assignment 4. So you're going to use SBNM 5311, which is our course, dash your last name, not L name, dash, this one's A3, and then you're going to do your company FRICT matrix, and then you're going to record a video about it. So it's basically you giving me an executive summary using the research matrix as your research backdrop that you can cross-reference as you talk to me about the the individual financial health of the organization that you choose. And I want this one to be no more than 5 minutes, you. I don't have to watch a second video while I'm at it. I'm Anisha. Some of you got around. Your intro video was 6 minutes and 34 seconds. I'm like, I know everything about you now. There was one part where you started talking about how you wanted money, and then you were like looking off into and then you got like existential for a while. Like, you know, let's use words and pictures to tell a 5-minute story here. And you're going to just submit that video then to the assignments. And this one you don't need to share with anybody else. If you want to, you can. I don't require it. I just need this one. It's the intro video that everybody needs. So here's the way your research process is going to work. If you haven't done it before with me, and many of you have, Brandel Library Online. Have you used online resources for us before? Yes, good. We have, although they are limited in volume, the scope and depth are great. And we're going to use this one. This is my favorite one. So go ahead and bring up Morningstar for us. Then from there, the second one you're going to pull up is sec.gov, which will be the Securities and Exchange Commission's website. And from here, I want us to do Nordstrom. So it should be touch sensitive, Nordstrom JWN. Once we get inside there, we're going to look for their 10Ks. So let's go ahead and look at their 10K. And there's a couple of different ways you can play with these, depending on your wiring. I'll show you them both really quickly. If you just click on the main link, This provides what's called the inline form. So it's like the giant PDF, right? Like, look at how many pages this thing is. And this is like what they use to print it so that you can, do it in a magazine. That's the one that we're going to use today. But you also might like, if you're doing this for your assignment and you want to get goofy and do some calculations, build some graphs, if you use the filing button over here, once you're inside the filing button, click 1. If you go to interactive data, click 2. You can then get inside things like financial statements, click 3. And then when you get to individual financial statements, like their consolidated statement of earnings, you can download the Excel from there too. So you can get their audited public disclosures either in visual form or in native numerical form if you want to manipulate the numbers. So those are the ways that you can play with sec.gov. I'm going to stay in line for today because the stuff I'm going to need from them, I'm from sec.gov. All right, let's do it again. It should. Let's see. So you're talking for which part? The numbers part, the interactive data part? Before this even? Okay, sorry. From here? Got it. My bad. Nordstrom. Yeah, sorry. First pick your company. So luckily, this is why they're recorded, right? You can pause it when you're home and go back, and then it's literally just select. Sorry. Thank you. I get ahead of myself sometimes. Then from there, this one. And then from there, think about it as 2 entry paths, either the inline one or the interactive one. And so we'll use the inline one. See how it even comes up? It calls it inline for you versus this one is saying, view the actual data. Does that help? Did you get there, Trevor? Yeah, just type Nordstrom in and it should come in a drop down for you. Yeah, and then when you guys can do any company you want, I'm sure you're gonna do Nike. You'll probably do Wilson since you work there, right? So, and I don't care. I like that context. It's like you understand it better. I encourage you though to do a services company instead of a product company because their cost structures are just so different that I think we overemphasize product companies because we know them. I want to do Apple because you carry an iPhone 15 now. Congratulations. But where do we work? We work at consulting firms and we work at educational firms and we work at the American Association of Nurse Anesthesiologists and we work at churches, right? None of those sell things unless God's a product now that I'm unaware of. All right, back to this one then. Same. Let's come up here and either type in Nordstrom or their trading symbol JWN. And let's pull up Nordstrom so that we can have multiple tabs of data next to us. Did we do a ton of Morningstar in here last quad? We did a little bit, right? Yeah. Not a ton. I love it though, because to me, whether or not you go into finance, accounting, marketing, consulting, or whatnot, we all have a primary responsibility to be storytellers so that we can participate in the decision-making process. Morningstar to me is a great way to start to tell a company's story. So look at what it tells me all in the beginning, just to start off with. Morningstar has Nordstrom rated as a 5-star company. That means they're hot for them right now. They would like you to buy it if you were asking their opinion. The primary reason that's driving that for them right now, their internal analysts have sat down and crunched numbers like you were asking your boyfriend for the analytics that go into valuation. We can do the same thing with equity valuation. Matthew, you guys do some good equity valuation in your undergraduate program? Use Gordon constant growth model and different price to sales ratios to come up with here's what we think it should be. And then you compare that to what the market is pricing it at right now. I've got this thing, if I'm Morningstar, valued at 40 bucks. It's trading at 14. What did we say, Alyssa, about your data? Things generally regress to the mean. If they've got the mean data in there, right, this thing should float. It should float on up to the 40 bucks. And I can ride it towards what they think should be its norm. So what do I need to know about them? If you look at them from a style box point of view, and if you've never looked at investment style boxes, they're one of my favorite ways to think about investing. Yeah, Morningstar has the brand on them. It's a 3x3 2-axis matrix that looks at size and value, where value is a derivative of the way that they are perceived to be able to give you the returns you want. So size is basically your small, medium, or large. You're a little company up to your ExxonMobil. And then the other axis is how are they going to provide you returns? If it's value, that's a company that's paying cash dividends to you. So that's like you investing in a bond type company. You put in $1, it's going to give you 22 cents. REITs are value almost exclusively and always. Versus blend, that's more Apple now. Apple is now paying significant dividends regularly because they just can't grow at 28% every year anymore, but they can still grow at 20. Versus brand new companies who are just booming and growing at hundreds of percent, but they started off at 15 cents and now they're, at $1 something, but you put enough capital into them and you can get significant return on share price. So style box is a great way to tell you, what am I getting myself into? This is a little company that's going to kick dividends. It's like putting your money in the retail bank because Nordstrom, what do they have there? Overpriced nonsense that you can get at Target. But they're a department store that is relatively consumer cyclical. They traded today between 1360 and 1403, and over the past 52 weeks, they've bumped up as high as 26 bucks. This number's a good one for us. This is market-based valuation, market capitalization. I wanted to go out and just buy every share from every shareholder so that I could vote for who's going to be on their board of directors next. It's going to cost me $2.2 billion to take all those owners out so that I have exclusive rights to dictate to them. Then they give you some fun analytics right here on the front that we won't talk about right now. What I love, and we're going to use some of this in a minute, is their analysis. I love when they talk to you about what their person, David Swartz, who's their senior equity analyst, is telling you. This is your doctor who's coming in and saying, you know what? You could stand to lose a couple of pounds. Your blood sugar looks okay, but we're probably going to need to put you on a cholesterol medicine. That's this guy's job. We're going to use this then in combination with the SEC site to produce this. So let's go ahead and take a look at what our template matrix is going to look like. Okay. All right. FRICT. I love the fact that it starts off with F. To me, the F in finance is always about flexibility and about what we think of as financial slack. You all have a concept that you use for this in your personal lives. If you need to come up with capital to make a debt payment, to put a down payment on a car, or you suddenly need to come up with capital in a hurry, you got a couple of places you can turn to. You probably have some cash reserves, I hope. You probably have a credit card somewhere. Or maybe you call mom and dad like, do I have $1,000? This says how quickly can you access capital. The measures that I'm suggesting that you're going to research fall into any of these different categories. And I swear to you, it's helpful for us too as professors right now. Like when you prepare a lecture, I don't remember every single debt rating and debt ratio and liquidity ratio, but you know who does? That one does. I don't know if it even does history. I think it does, doesn't it? Over on this left-hand side. I Yeah, look at, I was looking at GAAP versus IFRS in countries the other day. Yeah, look at, I was like, man, I don't know them all. I don't have them all memorized. So what would liquidity ratios be? Liquidity ratios, you've all done very rudimentary ones. This is the one that like you probably learned in financial accounting on day one. But there are some nuanced ones that I like this one. When I worked in consulting, we used this as a flex point, which was an interesting way for a company to use accounting and finance data to sell itself. Look at what cash conversion says. You take a look at your days inventory outstanding. So how much inventory do you have out there in the world? And then you ask yourself, how many days does it take us to generally collect on our accounts receivable out there? Then you compare that to how many days it takes you to pay off your payables, and you can figure basic stuff out. It's not hard. If you're a day laborer and every day you get paid $100 to work and you spend $20 on food, that's $80 a day. But when you're a company and you've got thousands of invoices outstanding, you've got inventory through your supply chain making its way to a site that has to take the bill of lading and has to take it into inventory and then has to give you your net 90, less what you owe to your employees, your vendors, and everybody else. How does that net out for you in terms of your ability to continue to add to the capital that I need for distribution? So we used to flex on this one, in particular here, day sales outstanding. So one of my consulting businesses that I run, its DSO is 14. It's my favorite thing in the world. Like every 14 days after I invoice, I get hit. Like my banking, I get a text message. It's the greatest thing. You're just sitting there and you're like, and you're looking like, hey, this company just, and you're like, you did, and then you're like, don't look at that. That's a number I don't want. Like, you can punch me and maybe take that. But we used to do it as a sign of clients liked our work so much that they would pay us on the spot. Now, the funny thing about it was we were prepaid by our biggest client. So our DSO technically was one on that. But when you would wait it out, if you had our biggest client, we're doing $1 million with them with a DSO of 1, and then you had a little client, we're doing $100,000 with them, and their DSO is 90. When you weighted it, we were like 14, and we're like, woohoo! Look at how great we are. But what it did allow us to do was have a lot of financial flexibility because that client was prepaying us. So what I would like you to do, I don't know this one, I've never done that one before, is when you do your FRICT analysis for whatever company you pick, I want you to pick a liquidity ratio, at least one. So you have a couple of ways you can do it. Either calculate it yourself or bum, 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 bum. My favorite part in Morningstar is down here, where you get the statements presented to you down below with the source data if you want to play with it yourself. 2310 tells me you did this with me way back in the day. Whereas if I want to, I can expand my data detail view down here. I can export that data and I can do all the calculations myself if I would like. Or Morningstar actually gives you the answers up above, where they have a place called Key Statistics, where, for example, they will give you by category different measures of things such as liquidity. Aren't these first two, the quick and the current, aren't those part of my liquidity ratio set up here? So I need you to report on at least two from each category. Yes, please. I don't need to see you do them. No. I trust that you know how to do divide. No, thank you for asking. 2 total per FRICT. So if we've got FRICT is 5 letters, I need at least 10 measures, not 2 from each. Thank you. I mean, you're welcome to do 2 to 3 each if you'd like. If you want to do 6 times 5 is 30, I don't mind. It'd probably be tough for you to cover that in 5 minutes, though, would be my guess. All right. And then I was like, all right, I got to lecture this tonight. So then they need capitalization ratios. What are those ones? And I literally, this is what I'm typing into ChatGPT. Just list for me the capitalization ratios, because otherwise I would do it into Bing, right? And Bing would bring me up Investopedia and Corporate Finance Institute as my first two hits. And I don't like the way that they've navigated in the commercial space. So when I said to you, you need financial flexibility, one of the things I said is you could just go to your sources of liquid cash, right? That's liquidity. Then what's the next thing I said? You could just lay down your credit card. How do companies have the ability to lay down a credit card? They can do it largely one of two ways, a very short-term way or more of a medium-term way. Short-term way, a revolving line of credit. Any homeowners in here yet? All right, you're a homeowner. Do you have a line of credit on your house? You don't? Go to your banker, or if you don't have one, we'll find you one. They'll do a baseline evaluation of your home. So you live in a condo, let's say. You spent $100,000 to buy it 5 years ago. They get an assessor to come in, they value that thing at 150 grand. When you bought it, you put down $80,000. So you had 20 grand in equity. Now, over the course of years, you've paid that down in 5 years. So you have $77,000 only in debt. You've built 3 grand in equity over that time. But you add it to the 50 in market value, you've got $53,000 in equity right now. They'll write you a revolving line of credit for about 60% of that. They'll give you a checkbook and say you can spend up to 30-some thousand dollars on whatever you want starting tomorrow. That's a revolving line of credit. What's that? A revolving line of credit, or on hers, it's a line of credit on a securitized. It's a securitized line of credit on a fixed asset in that case. Companies, it's more like a credit card. Like they don't. Yours is against your condo, right? Like you don't pay it back, they come and take the condo. Not the same for a company's revolver. It's unsecured. But yeah, he's like writing this down. How do I get that money? Right, Park Bridges. So right? Dude, this is, I mean, I bought my house in 2004 for, let's say, $500,000. 2 years later, they're like, your house is worth 700 grand. I'm like, it is? I haven't done anything. And they're like, yeah, here's a revolver for $150,000. I'm like, what can I do with that? They're like, anything you want. I'm like, anything? So I bought a car on it. I'll never forget that day. I'm in the dealership and the dealer's like, well, would you like to talk financing? I'm like, do you take a check? Like, what do you mean a check? I'm like I'll write the name Nissan on there and then you tell me the number and then I hand it to you and then you give me the keys and I GTFO in the thing. And they're like, and I did. You know what else I bought? An MBA. I bought an MBA on my line of credit, $70,000. I did. I bought an MBA on it. $120,000 on that line of credit. And then you know what happened? 2008 came. And then little Mr. Evaluator Man came to my house and goes, hey, your house is now worth $400,000. I'm like, I owe more than that. And they're like, yeah, guess what that means, sucker? If you want to move out, you got to write us a check to move out. Like, that's not how it works. So we stayed in the house. And then I got divorced. And then she got to stay in the house. That's called 2010. Then after that, you lose 40 pounds. Then you get a new girlfriend and life's good again. All right. So, thank you. He says he's now like 10 pounds heavier than he was back then. Right? Feels great. Damn, it feels good to be a gangster. All right. Other capitalization ratios too. I love the debt ratio because this too is most analogous to what you did when you bought your condo. What percent of my firm is funded in debt and what percent of the firm is funded by equity holders? And you'll see dramatic shifts depending. And I thought about making you do a comparison for this to begin with. I was going to make you do two different companies and put them side by side. But I was like, you know what? I don't want them to have to do 40 pieces of research. It won't, and I don't want to watch a 10-minute video. But while you're doing this, while you're at it, it's not that hard to pop open right here. If I got Nordstrom sitting here, I can duplicate somebody here. I can do Target right next to them, TGT. And we can do a couple of quick comparisons and just see what that looks like down here. So where am I at? Here's my key statistics. Here's your financial health. Oh, look at, here's debt to equity. Let's take a look at the end of 2023, 1.66. So for every $1 that an investor has inside of Target, they're adding $1.60 and change of debt on top of that thing. So they're highly levering equity capital to do things like buy real estate to build out more bricks stores. How's Nordstrom doing on that front? Oops. For every dollar of equity capital, they are borrowing 6. Who would you be more worried about? Yeah, Nordstrom. Yet they do have 5 stars, which then I don't know how easily this is found. Because I have this one in here for you too. You know, why don't you guys play along? See if you can find me a good I use FINRA Markets for this, but see if you can find me a good place for debt rating. Let's see if it's inside maybe their 10K real quick. So here's Nordstrom's 10K. I should be able to control F and search on this thing. Let's see if they have a debt rating we can find. Rating came up 113 times. Let's see if they have debt rating. The revolver contains customary representation warranties covenant and variable rate of affiliation on our debt rating. I don't see their debt rating listed inside. Can you see if you can find me one? I don't know where to find it quickly. Yahoo Finance is also a nice place to look. They may have debt ratings there. I mean, ask them. Maybe Morningstar hasn't. I just don't know where to look. But this is why, to your question before, I said pick and choose where you want to go, because the sources might have them. You could look at Moody's, you could look at Standards and Poor, or you could look at why is the third name escaping me? I can't. Chat GPT. What are the major rating agencies? Fitch. Let's see if I'm right. Fitch came up. Standards and Poor, Moody's, and Fitch. Well, can you find company ratings on Fitch easily? Can you look up Nordstrom? Excellent. Will you dump that into the chat room for us underneath this thing? So you can go to the rating sites directly and they'll do debt rating for you. All right, next category, risk. Where is my PDFs? Over here. Okay. So what does it say to us about risk? This is, I think, Amanisa and Alyssa, I heard you talking a little bit about this in your research, right? This is when we do financial modeling, this is when we do what we call scenarios and sensitivities. A scenario would be like, if everything went great for Nordstrom, that would be our most optimistic scenario for them, versus if it was COVID all over again. And then within each scenario, we could package different variables to which you were talking about results are sensitive. Like you were talking about how commodities have an impact on consumer pricing. So in a scenario for a company like Cargill, who does agri products, they're going to be highly sensitive to the CPI. And so we might create a scenario by which they're sensitive to CPI that would cause the stock price to tank, which would be a significant risk. So what are some of the risks that we can look at within the risk category? EBIT, and you talked about cash flows. These are good things that we can measure. The third one that I really like is beta. We did beta in here for a minute and 53.10, didn't we? Didn't we do stock pricing where we used beta to calculate the expected rate of return on a stock? Was that this class, or am I having flashbacks to other things in the world?
Did some Excel.
You did. We did some Excel. We did a stocks and bonds case. I graded those things. Most of you got 8s on those. because you forgot to adjust for the 1,000. You were listing me prices that were $90. I'm like, that's not how much they cost. Beta on Yahoo Finance, that's one of my favorite places. So Yahoo Finance. Do you remember what beta stands for? Or what it does? You said you did it in statistics. Did you guys do beta calculations in your statistics class? Probably. Yeah. You don't have access to that file quickly? It would if it was named stats 1490-Kaminsky-assignment 4 beta. This right here. Wow, that surprises me. Beta 2.45. What is beta in stock valuation? Do you guys even need me anymore? You just need me to tell you what questions to type in, don't you? I actually have a good friend whose daughter is doing that. She's working at Argonne National Laboratories right now, and she's working on optimizing ChatGPT searching so that you can come up with the optimal character searches to figure out what you want. Beta. Beta is a correlation coefficient that indicates the likelihood of risky sensitivity to market swings. So you were talking about market swings, right? So what this is telling me is for Nordstrom, on any given day, if the market went up by, let's say, 10%, people would get so fired up about new consumer income that they'd be like, what are people going to do? They're going to go to Nordstrom and buy $60 scarves tomorrow. And so Nordstrom stock would go up by 2.45 times what the market does. So it might go up 24% that day. And if the market dives, goes down 10%, then Nordstrom is going to go down by like 20-some%. It's a sensitivity measure. It tells a stockholder, how much risk are you taking on from volatility? So that can be something that how many PDFs do I have open here? There, 3 of them. So you might want to look at Yahoo Finance for beta. EBIT coverage. Oh God, this is one of my favorite personal health stories. When I left consulting and went into teaching, I took a 65% pay cut. I had no money, so I applied for a credit card. I got a flyer in the mail, filled it out by hand, mailed it in, and 6 weeks later got a rejection notice for a credit card. And it said on there, the problem was your EBIT coverage is below our allowable threshold. And I had just started at North Park. I'm like, what the hell is EBIT coverage? So I had to go look it up. There was no ChatGPT back then, but there it is. Here's what they told me. I owned a house at that point in time. This is when interest rates were astronomical, 6.5%. So I was paying interest on a $500,000 home that was like $1,300 a month. Then I came to work at North Park, where EBIT, what's EBIT? Earnings before everything except interest and tax. So cost of goods, SGA, right? So what does that mean for me as a household? So after utilities, after groceries, after all of my baseline expenses, how much money do I have left to pay for debt, to pay for at least my interest? And my EBIT was my EBIT coverage was 0.8. So it's like for every $1 I had to pay an interest, I had 80 cents to pay it with. They're like, we're not going to give you more debt, you dummy. You can't pay the interest you've got. I kept that letter for 20 years. So I don't know that Morningstar has EBIT coverage on it. That's one that you would have to calculate by downloading the numbers, or maybe some other site represents it for you. But that's a good one for you to think about, because it indicates payment risk. How can you pay back interest if you've got no money left? All right. These ones are fun ones in here. Income. Morningstar does a nice job of reporting these too. Morningstar does this one here under the key statistics growth category. I love this. This is a table form, a list of what you did, but not for the whole market, for a company. So what's Nordstrom done? 2013 to present, 11, 3, 7, 6, 2, 4, 2. They only, oh boy, there's the nasty gram that we expected in there. But what's their 10-year average like? Oof. No wonder they're undervalued. People look and go, and that share price can't move. You can't expand your market share if you're only growing at 2% on average over 10 years. These, like, you got to factor away, right? Like, I don't know how you sustain that in the data. So it's really, you're looking at 3, 7, 6, 2, 4, 2, 5, right? That's why they're in that value category of investing, which then tells me if I scroll down more and I look at the bottom for their dividends information, man, I should be seeing, what are they doing? Paying out $1.48 per share, $1.48, $1.48. Oops, sorry everybody, we got no money either. Right? But now look at climbing back up. And there's a lot of good market research that talked about. I mean, we can look this up. Someone want to look this up? In 2019, what was a share of Nordstrom selling for? If you, just to keep the math easy, if you assume it's the same as today, at what's today, 14 bucks? 14 bucks, and you're paying $1.48. That's a 10% dividend payout rate. So you're making like 10% interest on a savings account by just dumping your money into Nordstrom. Now, whose site is best for this? I think Yahoo's charting is actually the best. Yahoo and Y charts I like a lot. 5 years. What year was I looking at? 2017, did I say? 19. So 2019. All right, so that makes more sense. Look, they were trading up around 47 bucks. So what's $1.48 divided by 47? That one we're not going to use ChatGPT for. Equals $1.48 divided by 47. So they're paying like a 3% dividend yield. That's better than a savings account. So you could dump your money into Nordstrom. They'll kick off 3% for you. What are they paying today? What did they normalize back to? Down to the bottom again. Ownership. We got to talk about that one next. So they're paying $1. 5-year average. Trailing 12 months is 76 cents. So equals 0.76 divided by the around 14. They're paying 5%. You could walk away from this class and nothing else, go, man, I'm going to dump some money in Nordstrom today. I'll at least get a 5% dividend payout. Go and try to get that at Chase tomorrow. And you might get a price kick. Now, do you understand why they're 5-star? You just got to believe that they're not disappearing anytime soon. So, last thing in risk. Oh, sorry, I was down here. I moved up. Oh, but I also put in this for you, the Morningstar Moat, if you want to do that. I love that one too. That's up in their analysis. This is Morningstar's kind of, they talk about for Nordstrom about a loyal customer base. If you're a loyal Morningstar customer, you talk in moat terms, because that's kind of their branded way of talking about how defensible a company's strategy is. And so when you see something that says narrow moat, what they're saying is basically like, yeah, you put H&M next to Target, next to Nordstrom. And if you don't know the brand, you're going to go into all three and probably pick H&M. It's the cheapest. But if you've been to Nordstrom, what do you know about Nordstrom? They treat you nice in there, don't they? They'll tailor your pants for free, says the guy who wears only jeans. So they do have a loyal customer base, but that's pretty narrow because someone can steal that away. So you can talk in moat terms. All right. Net income growth, earnings per share. That one should be presented for us pretty quickly down here at the bottom. And I expanded that one section and it's killing me now. I forgot what I was looking for. Oh, EPS. Where's my EPS? EPS, no, this is only going to be 1 year EPS. All right, come on, search. I want the chart. There it is. It's underneath the financial statements piece. Uh-oh. All right, so that makes this is the one thing I don't like about Morningstar. Did you notice how the data was moving descending left to right? And now it's moving ascending left to right. I don't like the way this. I'm ascending left to right always. 2020, 2021. Well, from your point of view, 2020, 2021, 2022. So how's their EPS been doing the last several years? I mean, off of this turd burger, it's grown fairly significantly. So you can look at their EPS trends. ROE, all right, we know what that one is. This is the one that you got to have the 10K for. And this is the one I think that is probably the newest for most of you. So if you come back into the inline 10K and you search on that word covenant, which I love doing since we're part of the Evangelical Covenant Church of America, we as a founding denomination made a covenant with Jesus that we would accept him as our Lord and Savior because he was resurrected on the cross for us. And you have to agree to say that out loud to be a part of the church. It's one of their dictums, one of their rules. If you want to borrow money, you also have rules that you have to follow. We call them covenants. They're bonds in the terms of they bind you together. So these are fascinating to me. So for example, investment in capital. This was my job in working in REITs. Every day I had a financial model that would pop up that listed my top 10 debt covenants. And for example, one of the covenants was my debt to assets ratio. We couldn't exceed 80%. Because you know what a REIT is? It's basically a portfolio of highly levered properties. You're a property manager, you're a landlord, is all you really are. And then you're distributing your rents as income. So how are you buying properties? You're going out and taking residential loans at an 80-20. So we had one that said you can't go above 80. And I remember the day I showed up and I was new. I was like 27 years old and I opened up the spreadsheet and there was a box that was red all of a sudden. I'm like, what the hell is that? And I went and showed my boss. He goes, we got a problem. Next thing you know, I'm on the phone with Moody's that day, who said, you've got 24 hours to respond. We're going to do an AP Newswire indicating we're lowering your credit rating, which is going to mean high yield bonds. What happens when interest rates go up? Bond prices go down. So when your credit rating goes down, your risk goes up and your bond prices go down. And I'll never forget Mrs. Ira Silverstein, who owned 50 bonds. It was like this 80-year-old woman in Cleveland who was a pensioner who had 80 bonds, who called. It was like, what's going on with that? And I'm like, who are you? Why are you yelling at me? It's like, I saw the AP Newswire. Because we tripped our covenants. And one of the requirements was we had to disclose that. And we had to indicate to all of our bondholders our 30-day plan to remediate that. Those were part of our covenants. So if you search through covenants, you'll find some interesting things in terms of their bank is imposing upon them an EBITDA ratio. You know what this is. Earnings before interest, depreciation, amortization, and rents. Interesting. Why? Because Nordstrom has massive lease obligations all over the place. Is there a Nordstrom in, what's the stupid outdoor mall up here? Old Orchard. Yeah, is there a Nordstrom there? Yeah. Do they own that building? No, I think it's Westfield Properties that owns that building. So Nordstrom signed a lease with them. That lease ties them into probably a 5-year obligation. So they consider that like a debt payment. You can't circumnavigate a lease easily. So they have a whole separate EBITDA adjustment that they have to do. That's pretty cool. Let's see, any other interesting things in the covenants? So the sum of their leverage ratio, they have to do a slightly different calculation. And let's see. A deterioration in our capital structure or the quality or stability of our earnings could result in non-compliance with our debt covenants or a downgrade. That was like month 1 of my job, Mrs. Silverstein. So I really like this. I think you might have fun looking at it. And then, this is like REITs. When they have to figure out the dividends that they pay and they start thinking about how much are we going to pay out, the revolver prohibits them from paying out too much, because what does the revolver say? If you pay me first debt and then you pay the investors dividends and you pay out too much, when it comes to make your next debt payment, aren't I at risk that you paid out too much to be able to pay me next? So they're going to restrict my dividend payments too. So covenants. And then this one you can find too on Morningstar, ownership. This is this one here. These are fun too. I always like to look, see how much money people make. Only 3 million? Jeez. After making 5 the year before, like, poor guy. What's he gonna do? I hope his bank's imposing the covenants on him. Ownership over here. So who are the major institutions who own Nordstrom? You guys know BlackRock, Chicago-based. Vanguard, you probably heard of. State Street, I think they're also Chicago-based. Cooper, I don't know. But why this is important, when I worked later in consulting, our ownership structure had intentionally that our CEO was the only person who owned Class A shares. Everyone else was a Class B share. And in the event of a potential hostile takeover, only Class A shares got to vote. So me, although I was a shareholder, I had no say in it. It was only the CEO who got to determine it. So although this gave me some sense of like, I was down here 0.000, and he was only 2 point something overall on a Class B basis. But if you went into our 10K and you read our disclosure, you saw in the event of a hostile takeover, all Class B shares remain to Class A, and Class A gets the only vote. That is an issue of control. Who has control? We're going to look at that when we get into the merger between RJR and Nabisco and how they decide. And then last, and this connects it all to what you did last week, is, so what's the current market environment for interest rates? Is it easy to borrow right now? Is it relatively cheap? Is it relatively expensive? What does the yield curve look like right now? Nobody did that research, did they? Oh, I typed in yield rate because I was not paying attention. I was looking at That's not I want to see it in graph form. Yield curve graph. Good question. It was. Well, it looks like the American Eagle. Like, it's like Great America. It's like a rickety old wooden roller coaster that we're sliding down. And now we're going to crawl up to the top before we decide whether or not we're going to take another dive, which I think speaks to some of the uncertainty that all of you researched. So those are the resources that you're going to use to produce a no more than 5-minute video that's an executive summary walkthrough of a company of your choosing, where you're going to get to focus on the internal triage of some of their financial health measures that they look through regularly to determine, are they in a position to either close up shop, be in an acquisition mode and buy others, or maybe to be acquired themselves at some point. And then later on in the class, we'll look at how some of those decisions are made. And